What's up, Gould Miners? Today we welcome Alan Corey to the show.
Sometimes you might hear that real estate is an inflation hedge. It's not that the property is inflation, it's the debt is an inflation hedge, and you want to lock in that debt. So just buying real estate, no mortgage, that's not the same benefit as having a 30-year mortgage that's locked in place.
Alan is a multi-decade real estate investor and author of several real estate investing books. Despite growing up in the projects, Alan overcame those circumstances to become a millionaire before the age of 30. And in today's episode, we dive into the journey from Alan's humble upbringing all the way through to where he is today. At the beginning of today's episode, we talk about the current real estate market for both home buyers and real estate investors. Alan also shares his opinion on who should be buying right now and who should be waiting to buy. Later on in the episode, Alan shares his unique perspective on good debt, and he shares his views on utilizing real estate as a hedge against inflation. And then finally, we wrap up the episode by discussing some of the real estate strategies that Alan has used over the years, and he also shares his advice to new real estate investors on the kind of strategy that they should be deploying when getting started in their real estate investing journey. This one, it was an absolute blast to film, everyone. Alan has a ton of one-liners, my favorite one being, find the home that's ugly in the streets, but sexy in the spreadsheets. That's the kind of episode that this one is. So without further ado, let's welcome to the show, Alan Corey. Alan, welcome to the Gould Mine.
Glad to be here. Thanks for having me.
Yeah, man. No, this is great. And I think, just kind of looking through all of your history leading up to this point in time, I have a lot of context, but for the audience back at home who just tuned in, why should they stick around and what do they stand to learn by listening to this episode?
Well, it might have a side effect of getting them extremely wealthy. So it's not for everyone, I should say. But if you're into that thing and you're okay with the side effects, then yeah, stick around. But I've been figuring out how to make money for over 30 years. I didn't come from money. I felt like I was at a disadvantage. So I've tried everything and published multiple books about how I found ways to make money. And I still teach it to this day. When you say you felt like you were at a disadvantage, what makes you say that? I didn't have mentors. I didn't have anyone that I knew who was really rich. I had like two basketball coaches that they seemed like the richest people in the world when I was growing up because they could have a practice at 3:00 after school and everyone else's parents were at work and I never saw them in a suit and tie. And then I was like, okay, so that's the life of a rich person. And so some digging, I figured out that they are small business owners. They invest in real estate. And so I without them even knowing that they had an influence on me, I'm sure they were trying to teach me basketball, but I was trying to learn how to live their life. And so I'm just sort of put bits and pieces into action and gone from there. And so, I got started when I bought my first piece of real estate after reading every book I could. This was, I'm 45 now. And so this is pre-YouTube and social media, and like you couldn't just call up a rich person or tweet at them or anything like that. You could, no one was really sharing their advice. So I just spent my days at the library, every single book in the self-help, the finance section. I just devoured and just couldn't. I was just like, this is going to be my mentor, and overall, like I tried to do everything. And I was like, stocks isn't really for me because I can't control it. Really, I felt like it's a 30-year like horse race. Like I'm gambling a bit, but I'm just parking my money and hoping that those CEOs do well. Real estate resonated because I was like, I'm in charge. I get to decide what I'm buying, how I'm going to renovate it, who I'm renting it to, what am I going to charge, when am I going to sell it, all these sort of things. And so once I bought my first property, I just made a goal to buy one property a year for the next 5 years and just kept it as simple as that. And that sort of led to my first book deal, $1 Million by 30, because I was living in the projects, Spanish Harlem projects on 108th Street in Manhattan, and 108 and First, if anyone's familiar there. But I was living in the projects and I was like, let me save up. I saved up $10,000 to buy my first property. It was right after 9/11. When everyone was like, get the hell out of New York. What the hell are you doing and buying real estate in New York? Get very fearful, which is sort of the times we're in now. And that's always proven to be a good time to buy. And so, but I was like, this is the first time I've been able to afford a place. It was $100,000 in Brooklyn, and this was not when you wanted to go to Brooklyn. But I was like, great. Worst case scenario, if it doesn't work out, I'm back in the projects. Like I might as well bet on myself.
Yeah.
Right. Like worst case scenario, I'm back to where I was. It's a boomerang effect. Fine. But the upside, it was such an asymmetrical upside bet on myself. I was like, I could be, Barbara Corcoran or one of these other like big New York real estate titans if I just plugged away and stuck to it.
You said a lot there that I want to dig into. The first thing is, this is times like this are when it's time to buy. Let's explore that a little bit, because I think that right now, there are a lot of people who are sitting on the sidelines, waiting for things to improve. Why is that a losing strategy?
So in terms of real estate, I'm a realtor as well, and I've been in this for 25 years. So I've seen clients fall into this trap time and time again. They'll look for a property, whether it's a primary for themselves or an investment property, and they're not completely satisfied. Like they're not ready to make compromises. And I got to preface this by saying, when I help $2 million, $3 million clients, they're making compromises on square footage, on location. Like it doesn't matter what your budget is. Whether you're buying a $50,000 house, there's going to be compromises. Okay. So, saving for, let's say, I'm going to save another $25,000 because I don't see what I like right now. I'm looking at $300,000 homes, $400,000 homes. If I saved another $25,000, I can get that $450,000 home. That's going to not have any compromises. Time and time again, I've seen this happen. By the time it takes you to save that extra $25,000, whether it's 12 months or 16 months or whatever it is, that $450,000 house you're looking at is now $500,000. And so you're now buying that $400,000 house you passed on a year later for $450,000. So you just bought the same house for more expensive because you wanted to sort of save more money and get ahead. You can't outsave typically the home appreciation, of inflation, anything that's sort of affecting home prices and affordability of homes. Just get in the door now. Let inflation benefit you, and then let the tax breaks start working for you, and then start saving while you have your own house. And then maybe you buy that second home or the next property a little bit sooner than you would, because at least you have a solid base, a foundation that you're coming from, and you're in the real estate game. It's really hard to get that first step on the property ladder. You just got to get on it and then take the benefits of that. You can leverage that old property into your second property that has fewer compromises or makes you more money or whatever you want to do.
Yeah, I couldn't agree more. And what's interesting is that you're kind of coming at this from two different perspectives: the like emotional, primary residence perspective, but also the investor perspective, because you did both at the same time. You house hacked, right? You did a house hack for your first couple. So walk us through the sacrifices that were made when you're house hacking, because obviously, like, you're not just thinking like a primary residence, you're thinking like an investor at that point too.
Yeah. So a lot of people say is primary residence real estate investing, and I'll say no, because you're buying it, like you said, with emotional decisions. Like, what's my commute to work? What's the school district like? These are things that or more of your standard of living, right? And it's okay to pay a premium for it, and it's okay that it's not an investment. You're not maximizing every dollar. It's fine to invest in your own lifestyle. It's just you're not going to get the return on investment as you would an investment property, which is a spreadsheet decision. You're just looking at the numbers on a spreadsheet, and you're looking and saying, hey, does this make sense to buy? Yes or no? It's a very calculated, decision, like literally figuratively. I always like to say, real estate investors, if you're a real estate investor, you want your house ugly in the street and sexy in the spreadsheet, because that's usually the way it works. A primary residence buyer usually does the opposite. They want the sexy home, but it doesn't make sense in a spreadsheet, so that's how you kind of, tell the difference between what kind of shopper you are. Multifamily house hacking is sort of my preferred way that I teach people. I have a company where I teach people real estate investing. And what I tell them is that's marrying those two things a little bit. Say you buy a quadruplex or a duplex or a triplex, something that's 4 units or fewer. You get the same mortgage as you would if you're buying a single family house. You can put down the same down payment. That could be 3.5% down if it's an FHA loan, or 5% down, conventional loan. And you get the benefits of both because you get to live in one unit. And then let's say you have a quadruplex, you have 3 other units that are help paying for your mortgage, if not all your mortgage or more than your mortgage. And that's really accelerated my lifestyle because I found a property where I lived in the unit and I rented out each of the other. It was a duplex. I bought it with a primary 10% down loan. I rented out all the other bedrooms by the bedroom, $600 each at the time. This was Brooklyn, New York. No one wanted to live there, but I was making $2,000 more than my mortgage payment. And I was at a job making $45,000 as a tech support operator at the time. So that it was actually more money than I was making at my tech support job. And I was like, that's when I got the bug. I was like, oh, I just need to buy one of these a year, rent them out. And as long as I can cash flow it, and meaning all expenses and property management or whatever, fees are paid by the tenants, plus I get a little bit extra. Oh, it's a no-brainer. I can see my exit out of the corporate 9 to 5. It's just, I just needed 4 or 5 properties. And I was like, oh, then I can live whatever lifestyle I want.
So I'm curious, what were the interest rates like back when you were making those first investments?
Same as they are now. They were first property at 7.5% interest rate.
Okay.
And so, I definitely benefited from going down and the interest rates over the last 25 years. But I say this, I don't care about interest rates. It doesn't matter to me because what I mean by that is, if we'll speak about investing, if I'm looking at an investment and it cash flows, I've seen great deals that cash flow even with a 20% interest rate. I've seen terrible deals that I would never buy with a 0% interest rate. So the interest rate doesn't determine whether a deal is good. It's a variable. And you have to plug it into some spreadsheet and then determine whether it makes sense to you. But that doesn't matter. That doesn't tell you if it's a good market or a bad market. So that's one thing. And then if you get a property today and you feel like, oh, interest rates are too high to buy a property, one of 3 things is going to happen. Either interest rates are going to stay the same, and you're going to be like, oh, well, glad I didn't keep waiting on the sidelines because 5 years later, 10 years later, the interest rates were the same and they haven't changed, right? The second thing that could happen is interest rates go up and you're going to be like, oh man, I'm a genius. I'm so smart. I timed it right. I got my 8% interest rate before it went up to 10% or whatever it is, right?
Yep.
Or the third thing could happen is interest rates go down and then you refinance. And then you're like, at least I got my property and now it's cheaper for me to own. So to me, everyone's so worried about interest rates, and it's like that's just, I don't even focus on it. It's just a variable.
Yeah. And the other thing there too is, and this is what I tell all of my people, because I don't know if you know this, but like in a past life, I was also a realtor. And so when rates go down, you can obviously refinance and that's great. You've also locked in a lower price because for sure prices are going to go up when rates go down.
Well, still typically what I've seen is, yes, when rates go down, prices go up. But when interest rates go up, prices plateau. So, just because rates go up, it doesn't, I haven't seen the properties go down. Like over 20 years, it just stays the same. So, just get in. And so, you'll double win. You get the lower cost monthly payment costs, but then, the home appreciates the value because now interest rates are lower.
100%. So it's like either, whichever one of the 3 scenarios, you're always better off buying sooner rather than later. I would agree. I think there's very few instances where it would make sense to wait. I mean, there's obviously like exceptions to that rule, right? But very few, very, very few, very, very few.
Well, sorry, I'll jump in and say, what would be a worry would be unlimited supply, right? Supply and demand, Econ 101. When will we have too much supply of homes? When is it going to happen? Last time that happened was the Great Financial Crash, and that was caused by lenders. Everyone could get a loan. So everyone could get a loan, and then that experiment didn't work when they were all interest rate only loans or adjustable rate mortgages. 2 years, 3 years in, when it came time to refinance, and everyone lost their home. So we had this glut of properties hitting the market. Okay. So that is what makes home values come down. how would we recreate that event in today? It is always what I'm thinking about. It would have to be possibly another mortgage event. I don't see that forthcoming because everyone's locked in 3% interest rates, 2% interest rates. It's really hard to be underwater on property. They changed the laws. They changed the laws in 2010, so you can't do these no doc loans where it's stricter. It's harder to get approved for a loan. So over the last 14 years, it's been highly qualified buyers more than they used to be. So I don't see a glut of properties coming through foreclosure or anything like that. The other thing would be building. Maybe we have this glut of builders who've just knocking out 1 million properties a year, more than we expect, and we just have too much inventory. Well, that hasn't happened because builders haven't found a way to make money in the last 5 years because interest rates are high and the land costs are high. And it's just too risky to build a giant neighborhood. So they'll build 2 homes or 3 homes rather than the 50 homes in the middle of nowhere. Because it's too risky. I don't know what interest rates are going to be when I'm done with that project in a year and a half from now or 2 years from now. And if the interest rates go up 2%, then I just did 2 years worth of work and I'm selling it for what it cost me to build it. And that's no builder's going to take that risk unless there's like government incentive programs or which we don't have right now to kind of push this building of properties. So I don't see that supply coming from builders either. And so it's been sort of COVID also wiped out a bunch of the flippers and We Buy Ugly Homes because a lot of those courthouse step purchases are from people who get foreclosed on for whatever reason. They've lost their job or they can't fix up their home. But when there was a mortgage, eviction moratorium and there's mortgage relief, that basically wiped out all the house flippers because there wasn't enough. There are hardly any homes at the courthouse steps to flip. It's an ecosystem, right?
Yep.
Whether you love them or hate them, it's a larger supply of an ecosystem. I'm helping this guy get out of trouble, and I'm making a nice new home for this new first-time home buyer. And so all these sort of people who were during COVID or pre-COVID were house flippers. They've all found other careers and different jobs now, and they're kind of reluctant to get back in because interest rates are a little high. So these are all like 3 different ways that the foreclosures and from bad lending practices and oversupply of building from builders. None of those things are happening anytime soon. So I don't see home prices going down. And so, the common refrain that you'll hear throughout this podcast, get in today. I don't benefit whether you buy property or not. Like people are like, well, you're just saying that because I'm a realtor. No, I don't care if you're buying a house in Texas or California. It doesn't affect me. I'm just trying to tell you like what I've learned over 25 years here.
Yeah, I couldn't agree more. I mean, just knowing what I know and having, been in the game for like over a decade now, it's been pretty obvious to me that even when you study like historically the market and what it does during even bear cycles, bear markets, we typically see housing thrive even when the economy is going to shit, and that's a very interesting factoid that not a lot of people actually realize. It's like, what is it? 4 out of the last 6 bear markets, housing's gone up. Housing prices have gone up.
So, I mean, if you're an investor and you rent out properties and there's any sort of financial crash, people lose their jobs. The economy suffers, right? Yep. So when people lose their jobs, it's harder or impossible for them to buy a house. So it creates more rental demand. So if you have a property in a down economy, you probably have more renters than you normally would in an up economy when everyone could go get a 3% mortgage interest, loan kind of thing. So, you can weather the storm. Also with real estate investors, let's say property values go down 20%, 30%. If you bought on just basics of real estate investing and the cash flows, just because the property value goes from $1 million to $800,000, that doesn't mean your rent drops from $1,000 a month to $800 a month. There's a 12-month lag on your leases. But in that situation, again, there's more rental demand than typical. So it doesn't decrease rents. Like it may be marginally 5% here or tickle down here or there, but I haven't seen ever a situation where whatever's happening in the economy has created a situation where rental income is now below what your mortgage payment is, kind of thing. Like you're going to be able to weather any storm. And that's what's great about real estate investing is you get to decide when you want to sell. In a down market, I just won't sell. I'll just keep collecting cash flow when there's high rental demand. And then whenever I do want to, wait it out until the market's great, then I will sell. And so that's different back to primary home buying. And now that's different than primary home buying, and everyone's horror stories and what makes the headlines and what your parent tells you or uncle about the scariness of real estate is all the real estate they've ever bought. It was bought on emotional decision, what we talked about earlier, but also life timing, meaning they needed a house that, summer, whether because their kids had to start school, because they started a new job, they got married, they had a baby, they had a divorce, whatever it was, they needed a house in a really narrow time frame. Which that's not, investors don't operate that way, but primary home buyers do. And then when they need to exit that property, it's the same thing. It's a lifestyle timing event that's forcing the sale. The market's down. They lost their job, marriage, divorce, whatever, death in the family, something. And then they just have to sell it because that's timing just appeared and they have to sell it. So all their real estate experience is based on a lifestyle decision to purchase and a timing decision that, investors don't go by. And that's also how they sell primary residence properties. And that's not what investors do either.
How did you insulate yourself from the emotional roller coaster that can be real estate? Because obviously you've learned all of this over the years, and a lot of people, especially if they're first time investors, don't know how to separate the two. And so what strategies did you develop over time to keep you from kind of giving into that fear mongering, that herd mentality that so many first time, investors, whether it be in the stock market or because you see it too, like people selling out their stocks when they shouldn't, and kind of feeding into that herd mentality. How did you insulate yourself from that?
Well, yeah, you real estate's it's a feature that it's illiquid. Like, the fastest typically it can sell properties in 30 days, right? With stocks, you can sell it in 30 seconds. So, it's a whole process to let me talk to a realtor, let me fix some things before the photographer comes. And then eventually you're like, oh, it's not so bad, right? So that's kind of a feature of real estate is that it takes a slow time to sell. I looked at it was that, I always look 5 years in advance, 10 years in advance. I think every investor should, it's not day to day, unless you're a day trader, which we know that's very speculative. Real estate, it's not a get rich quick. It's not get rich today. It's get rich eventually. And so I was just look at it and be like, okay, even if I broke even, worst case scenario, the tenants paid for all my expenses, my property taxes, my mortgage, insurance, I broke even. They still pay down a good chunk of my mortgage balance each month on a property, kind of thing. So I feel like I'm still winning there. I still get tax breaks. I can write off some improvements and depreciation of the property. So there's a lot of things that I still would look at the benefits of it. And when everything's falling apart, the opportunist in me is like, oh, this is a good time to buy. I can take someone else's, worries and turn them into my gain. And I'm not taking advantage of them. They were uncomfortable and they want to sell at a lower price to get out. That's fine. Let me buy and I can weather the storm. I look at real estate. My approach to real estate is a mutual fund approach to real estate. So just like not buying one stock and, whether that company win or lose, you're riding that one stock. You would buy a mutual fund of properties, which, sure, you buy 1,000 of stocks, 200 are going to be bombs, 200 are going to be winners, but you're going to get the average returns. And so I sort of tried to do the same thing with real estate. I was like, if I just have one property, then all my eggs are in one basket. I'm riding this one house. But if I got 5 different properties and they're all duplexes, so 10 different units, 2 could be vacant at any time and I'm still cash flowing. It's still property. I'm still making money as a whole across my portfolio of properties and my mutual fund approach. And I always say that each property comes with imaginary lottery tickets when you do this, because the more properties you buy, you do have that ability where one just is a home run. You bought it for $200,000, 10 years later, you did nothing. A new headquarters came in, a new park was built, a transportation hub or something was built, and that $200,000 property is all of $1 million property. And so, wow, I just made $800,000. That would not have happened if I tried to just keep one property and try to pay down that mortgage and just, let me try to pay off that $800,000 mortgage. No, I want as little money, as many properties as possible, and buy as many properties as possible. So I get those imaginary lottery tickets and that mutual fund approach to weather all the storms.
So you brought something up there where you talk about leverage, right? And that's one of the beautiful things about real estate. And a lot of times we don't talk about it, I feel like, enough. It's one of the greatest things about buying real estate. But some of the gurus out there obviously don't feel that debt is a good thing. And so you've talked about, in previous podcasts, I've heard you talk about good debt in real estate. So can you explain what constitutes as good debt and how you've successfully used it?
Yeah. Anyone who tells you to pay off a mortgage is not a guru. They don't understand real estate. They don't understand money. Like, you don't have to love math to understand this example I'm about to give you, but you have to trust math, kind of thing. And if you trust math, it makes zero sense to pay off your mortgage. So the story I like to share is, imagine that you pull into a gas station, you find $1 on the ground, and you pick up that $1, and you have two choices. You can listen to Dave Ramsey and mail that $1 into your bank, and pay off $1 of your mortgage payment. Or you can do what I say and go in and buy a bag of candy, for, maybe one Snickers bar for $1 in the gas station. That is my financial advice to you. And that may seem counterintuitive, but here is the other way you could play out. Let's say you left that $1 on the ground and you just drove away from the gas station, and you came back 15 years later. You come back 15 years later, that $1's still there, and you're like, fine, I'll finally pick it up. I'll go do something with it. Okay, so 15 years later, you can pick up that $1 and you can still go do what Dave Ramsey or Susie Orman or any of those guys say and mail it into your bank and pay off $1 of your mortgage payment. Great, that can be done. Or you can now go into the gas station and you can't buy anything because Snickers bars are $4 now. And you're like, oh man, why? What's going on? Well, that's inflation. Like, if you can lock the price of anything around you in place for 30 years, why would you want to get rid of that benefit? Because everything else is going to go up in price. And so you should go buy all the goods you want now, all the Snicker bar, all the, meals out, everything now, rather than paying down your mortgage. It's the biggest expense in your life ever, like the monthly expense. And you're going to have it for 30 years. And it's such a beautiful thing to lock in this expense when everything else is getting more expensive. So it just doesn't make sense to ever pay it off. And it does make sense to, if you're about to pay it off, get a new 30-year mortgage. I'll walk into antique stores, and I'm in Atlanta where Coca-Cola's headquartered, and you see like 5-cent Cokes and 10-cent Cokes, right? And now it's $3 a Coke. But, if I could go to Coke and say, hey, can I lock in the price of Coke for $3 for the next 30 years? They would be foolish to accept it, but I would be genius because I know in another 3 years, Coke's going to be $10. And then I could start selling, Cokes. So that's good debt, and that's leveraging. And you get that benefit only in mortgages to lock in the lowest interest for the lowest money you can borrow for 30 years. And it's also why everyone's grandma seems like a real estate genius, because she lives in some great property, and you're like, I can't believe you only pay $700 a month on your mortgage. Oh, it must be so nice to be you. And I promise you, when your grandma bought that property, it felt expensive. She felt like she was pushing her comfort zone. Yeah. She felt like, this is taking all my savings, and all it took was get rich eventually. And 30 years later, she looks like a genius. Oh, you're so smart, and no one thinks that they can do that. And you can do it. Just buy any property and wait 30 years, and you're going to come out ahead. Yeah, and that. It's an interesting example that you gave there just now, right? Because you're like, hey, we're locking in instead of using the cash to pay down debt, use it to go buy something that is going to increase in price. Right. Because the debt is fixed. And what you're saying is that, like, over time, inflation is going to drive the rest of the goods up.
So why pay down something that's fixed when you can instead buy something that for sure is going to go up?
Right. Sometimes you might hear that real estate is an inflation hedge. It's not that the property is inflation, it's the debt is an inflation hedge, and you want to lock in that debt. So just buying real estate and with no mortgage, that's not the same benefit as having a 30-year mortgage that's locked in place.
Yeah, that makes a lot of sense. And that's a really interesting way to look at it. So is Dave Ramsey wrong?
Yeah, I think and I think Dave Ramsey knows he's wrong, but it's easier to connect with his audience to teach them things that they think is true. And I think his audience is for getting out of debt, and my audience is for creating wealth. And so we have different audiences, and I think there is some points to say, yeah, get out of debt first, and then take on the right types of debt. And so his advice is probably good for getting out of bad debt, but he starts putting your house into that category of bad debt, and that's fundamentally incorrect.
I mean, I couldn't agree more. I always chuckle when I watch his stuff. I think it's interesting to say the least. What would you say, Alan, is the greatest setback that you've encountered in your investing career? Yeah,
so believe it or not, you can go broke buying good deals. And I've built maybe about 10 houses from scratch, sort of the 1 million price point, buying empty lots or houses that were tear downs. And this was, maybe 6 or 7 years ago. And I just knew the numbers on the back of my hand. Hey, I can buy a lot or a tear down for $400,000. It would, at the time, to build a new house, probably $450,000. Let's call it $500,000. So $900,000 all in. I could sell them for 1.1 to 1.2 all day. And so I was just trying to acquire as many $400,000 or less properties. I did sight unseen because I was like, I could make $200,000 each year. And what I didn't take into account was that my builder could not build infinity supply of homes at the same time as I was acquiring the properties. I was acquiring them more than I could sell them. So we got in a situation where, I had an empty property that I bought with a hard money loan, and he couldn't work on it for a year. And I think it's really expensive. And then, so they only lost money on one property. It was a beautiful property. And the benefits were that we ended up selling it for, I think, $135,000, so $150,000 more than we thought it would 2 years later. But it cost me, $200,000 more than I thought it would. And we ended up losing $50,000 on it. So that's sort of like, we did work for 2 years and lost $50,000, even though the prices went up. So that's one of those things where I learned, when I started relying on others. I'm not a builder, right? But I had a builder that I trusted and knew could do the work and knew his numbers. And that's when I was like, I need to have more builders in my pipeline and branch out and work with different people so that I don't get, what is that? The bottlenecked and sort of building your real estate. And I've also pivoted since then and prefer now the buy and hold rentals more so than the building new construction, just because buy and hold, you can get money at closing. Day one, you're getting rental cash flow, buying a property that already has tenants in it. And, it's windfall investing with building homes, because you get a big windfall every year, every 2 years, but it can also be a big loss. And I see so many deals every day. I want to be putting it to work immediately. I don't want to tie it up for a year or two to build anymore. But I appreciate those builders out there who do, because there's obviously a supply for the necessary home buyers who want new homes.
Yeah, that's really interesting that you've kind of pivoted your strategy. And so it sounds like, you were house hacking for a while. You built up the portfolio. Then you started diving into the new construction realm and then realized, maybe this isn't really for me. Then you've also pivoted. I know that you own a retail center now, correct?
Yeah. So I am a bit of a jack of all trades. I don't know if that's my ADHD, but as a realtor, I'm looking at properties every single day, and I just see opportunity. And when I see opportunity, I buy it. But also, I teach real estate. So I bought a couple short-term rentals because people are asking me about it. And I was like, let me do it myself before I try to teach you. Like, I just didn't feel comfortable teaching things I didn't do. So I bought apartment buildings. I bought a 50 single family home portfolio that was a couple hours from me, sight unseen. I'm office hacking right now. So this is a 9-unit retail strip. The tenants pay for my office space. And so I'm in one of the offices here. And so I try to do everything so that I can talk about it. But also I was like, can I make more money here? How do I do this? I just wanted to learn about real estate. It goes back to my original craving of knowledge in the library. I wanted to learn it. I didn't go to school for real estate. And what I finally learned is most residential real estate investors don't come from money. They're self-made. Most commercial investors come from money. They have a mentor. They have a trust fund. They have rich people network that pools money together. I didn't have any of that, so I'm learning that now that I'm wealthier. But and I'm sort of pivoting back to my roots, which is, I understand this game the most. It's more me in charge. I'm not taking other people's money like it takes to buy apartment buildings. I've got 300 doors in apartment buildings, ranging from 20 units to 150 units, and it's a whole different beast. And you can make money, but it's also riskier. I think it's when you have money, it's riskier, and it goes back to lending. Because in commercial deals, typically you don't get a 30-year fixed mortgage. You get a 7-year ARM or a 10-year ARM. And so you are refining or selling every 7 years or 10 years, and you're just hoping that interest rates are going to be good in 7 or 10 years. And that makes me uncomfortable. I'm okay with it. It's less because I can weather the storm because I've been doing this for 20 years. But I never had that worry, and I don't have that worry on any of my 4 units or fewer because they're locked in for 30 years, and I don't have to refinance. I don't have to sell if I don't want to. But you see that all the time. Commercial gets hurt because the timing is bad, and I don't like living my life and my investments based around timing.
Yeah, for the first time in a long time, too, the commercial sector's hurting big time, and it's exactly what you just said, right? So obviously, when people are getting into those 7-year products, 10-year products, 5-year products, you look back where rates were 5, 7, 10 years ago, where they're at right now, it's night and day. And that's Armageddon for the commercial sector right now.
Yeah, because commercial, it's based on how much income it makes. That's how you get approved for a loan. It's less so what other properties like that have sold for. It's less so what your personal finances are. So if all of a sudden you're making money at a 3% rate and you have to refinance at a 7.5% rate, and now it doesn't cash flow anymore, you either have to foreclose on it or bring money to the table just to refinance. And so sometimes, that's called a capital call, where you got to call the investors and say, guys, this is not working out. Give me more money. And everyone's like, what? You're like, yeah, but we got to bring $200,000 to the table to get a higher interest rate and make no cash flow. And so that's not how I want to live. It's gambling to me.
Yeah, no, it makes a lot of sense. And it's an interesting perspective. Coming back to the switch over back to the, more buy and hold traditional residential play. Right now, is your main focus buying kind of turnkey assets, or are you doing a lot of BRRRR situations right now?
So in between. So real estate's a totem pole. There's I always say you can make $1 million a million different ways in real estate, and it's where do you want to be on that totem pole? Not necessarily the top is the best, but you could be that wholesaler who finds off-market deals. You could be the person who at the courthouse. You could be the person who renovates the property. You could be the person who tears it down. You could be the person that builds it up. You could be the person that buys it, and you could buy it anywhere up and down that different levels of condition on that totem pole. The money I see right now, and it takes a little bit more money because you have to purchase a property and then renovate it yourself. I like properties where it's rentable as is, ugly in the streets, sexy in the spreadsheets.
I love that, man. That's so funny.
I have opportunity to renovate it if I want to. I might not do it day one after I close because it'll make money day one. It's fine. And it might have a wonky floor. whatever. And, but if the market turns around or I see an opportunity, wow, I can put $10,000 into this and raise rents $400 a month, then I'll do it.
Yeah.
And if I don't have $10,000 today to do that, that's fine. I'm still happy making, $100 a door on it right now or whatever it is.
Yep.
And so I also like small multifamily for that situation because typically, let's say you have a quadruplex. Most of them, not all of them, most of them have the same floor plan. And so what I would do is just renovate one unit and see, can I push the rent? Let me renovate this one unit, has the exact same floor plans as the other three. I'll figure out how much it cost me to get there, renovating that one. And then I see what I can rent it for. And if it makes sense and the ROI makes sense, then I'll do it to the other three. And then if I do it and it doesn't make sense, then I don't renovate the other three because what's the point, right?
Yep.
And I wait until the time where it does make sense. So I kind of like just testing one unit at a time renovation rather than a building that's, a complete burr where I'm going to add tons of value. Because to me, that's sort of the same strategy as building where you have this huge lag and you're hoping interest rates are good in the future and you just have months and months and months of no cash flow and no income. It's all outgoing. And I do that when I have like a slush fund of real estate, but funds to put to use. But it also eats up all my time, and I like singles. So I just like singles and doubles that are every month rather than a home run every 12 months kind of thing.
Yeah, hey, that makes a lot of sense. And honestly, I mean, it clearly has worked out very well for you. We're coming up close to time, but there's a couple other questions that I wanted to ask you, Alan, specifically around the current real estate market and the climate and the approach right now to investing, because your investing strategy has evolved. Would you say that it's more evolved with your personal, just kind of what's the word I'm looking for here? Like your personal appetite for certain deals, or would you say that your investing strategies have shifted as the market has shifted? I
think this is what you're asking me, and maybe what's my advice for others on what strategy they should pursue. And if that's not what you're asking me, then we'll go back to the question. But my answer to that is, I think everyone should invest in an expertise in your wheelhouse. And so a lot of people want to diversify. I'm going to buy a short-term rental out of state. I'm going to buy a local single-family house in a good school district. I'm going to buy a triplex near the university. And that doesn't build expertise because you're getting reps in 3 different types of exercises here. And they have different property managements, different tenant requests, different repairs and the quality of repairs that you have to do. And it's hard to build sort of the confidence and the knowledge to really juice every property for what it's worth. Uh-huh. And I own the most of small single families. And so I know the contractor to use on these properties. I know what it will rent for. Just looking at photos online, I know what I would do or not do. I know what streets to avoid and not to avoid. And so that gives me the reps, just the turn around a flywheel so quickly that I know much more on a faster basis and I do a better job. And so because of that, it's easier for me to make a yes/no decision. Okay. And it should be easier for other people to make a yes/no decision. So when I'm evaluating a strip mall, that was the first time I've ever done that. It takes up all my time and I have to do a lot more research and a lot more due diligence, a lot more asking questions to friends who do this thing. Yep. And then once I'm in, it's like, oh, now I got to learn how to write commercial leases, for businesses. I've never done that before. And so I'm always in learning mode rather than executing mode. Yeah. And so there's time and a place for both. And but if a new investor is listening to this, whatever investment property you have right now, you're the most qualified to buy another one of those investment properties and another one and another one. And then if you want to get out, that's fine. But at least you built the expertise, you juiced it for everything it's worth. And then you have enough money to pivot into something that you may be more interested or passionate about or want to put your money into.
Yeah, it makes a lot of sense. So as opposed to thinking about, okay, well, the economy and what the timing and, all those things, it's more of let's pick a lane, stick to it. And then at a certain point, because, and the reason I asked this, Alan, right? Because there's so many different thoughts, right? Like I know people who, have adjusted or pivoted their strategies and their whole investment thesis when the market shifts. And then there's some people that like yourself that are just like more focused on their own game, right? And not so much about like the noise. And so it's just interesting to hear different perspectives.
Every strategy is going to have its moment in the sun. Office Space had its moment in the sun with WeWork and everything. Yep. And now it's out of favor. Short-term rentals had its moment in the sun. And I feel like, cities now are changing the laws on short-term rentals. Mm-hmm. But the people, it was a gold rush, people who got in, printed a lot of cash. Some still are. Mine's doing pretty well. But sure, they might change the rules one day. So I only buy short-term rentals that I can pivot and turn them into long-term rentals and they'll still be profitable. And so I encourage others to do that too. Whatever the strip malls, those are probably still having this moment in the sun a little bit, depending what type of businesses you have in those, the service-based businesses, the barbershops and the pedicures and stuff like that, where people always need these things, except during COVID when you're denied going to these things. So it's has a Phoenix effect. Like it was terrible during COVID, but now it's doing much better. And so it's hard to chase something because I feel like it's temporary. But the boring old apartment building where the family lives in, that's not a trend. That's not going away. Like there's always going to be a need for that. There's always going to be people who are moving up in life and moving into a duplex is unlocking a new wealth bracket for their family. And there's also going to be people who are moving down from the $1 million mansion and moving down in life. And they're happy that there's a duplex there. Like you get people coming up on their journey and people down on their journey at different times. I lived on no judgment. I lived in the project, right? And I might end up back there again. And it's okay. I've done it before. And I'm glad there's different housing options where I am in life. And to provide that for people, that's not a fad, and that's not going to go out of style.
Alan, you've been awesome, man. This has been a phenomenal show, and in typical Gould Mine fashion, I'd love for you to leave the audience with one final gold nugget.
Wow. Okay. Well, I have books of gold nuggets. I'm trying to pick out a good one, but I told you the side effect of listening to this podcast is you might get wealthier. So that's definitely going on here. So let me see. I think it's people get analysis paralysis when it comes to real estate investing, and it's normal. Am I making the right move? Should I buy this? And so my approach to overcoming analysis paralysis is in my book, House Fire. FIRE stands for Financial Independence, Retire Early. And so how to do it with houses. And if you're familiar with the FIRE movement, there's a math formula that says basically if you have 4 times of your expenses, 25 times your annual expenses in a stock account, and you withdraw 4% of that every year, you can retire early. That doesn't make sense to me. I was like, there's got to be a better way to do this with real estate. And so there is. So the example I like to use is the FIRE movement. This is not what I made up. These are the frugal personal finance guys out there. And I used to be them. I used to be my $1 million by 30, live way below your means, live in the project. I've been there. I get it. But what I've learned is that there's things that are wrong about it. Let's say you have a phone bill, internet and phone bill combination, family plan, whatever. It's $150 a month. 12 months of that, 1 year is $1,600, I believe, $1,600. And the FIRE formula to see if you can retire is if you have 25 times that, so $45,000, put it in the stock market and you'll be protected. As long as you withdraw 4% of that, that's called the 4% rule, 4% of that 4% of that $45,000 in the stock market every year, you'll have your phone internet bill paid off for the entire year. And that math shows that should at least last 30 years, if not longer for you. My approach to real estate was like, that's terrible. Like if I have to do that for every expense, sure, I have to be a millionaire, and I get it. If I have multiple millions of dollars, yeah, of course I can retire and I can leave my day job. But not true with real estate. So if I take half that, instead of saving up $45,000 just to pay my phone bill in retirement, half that's $22,500. I can go out and buy a piece of real estate, put $20,000 down on a $100,000 property. There's $2,500 of closing costs, expenses, repairs, whatever. And you might say, Alan, you can't find properties for $100,000. I buy them every day. I bought a portfolio of 50 of them. They were $35,000 each. And I recently sold them for $65,000 each. So someone else just bought them for $100,000 less than. They might not be in your town, but they're in pockets of middle America and Southeast. And you can get a property manager. They're going to cash flow. And the same sort of good people who need a place to live in these towns. It's not your town, but you can still invest in them. All right, that's beside the point. But for $20,000, I can buy a $100,000 property and it'll cash flow me $150 a month. There, I don't have to retire like in 30 years. I don't have to withdraw anything from that. It cash flows $150, which pays for my phone and internet bill. It burns it up. It's the house fire approach. And so if you have analysis paralysis, rather than saying, is this a good deal or is this a better deal? I like to say, all right, if you want to retire through real estate, let's write down all your expenses. Internet, phone bill, $150. How much money do you have? $22,500. Great. Let's go buy a property that cash flows $150. Boom. Does it? Yes, no, buy it. Let's move on to the next bill in your life. Your utility bill, your gas, whatever, water is $100 a month. Okay. Well, let's go. How much money do you have saved? $15,000. Okay, great. Let's go put that down. Let's go find a property that's $75,000 or something, or creative seller financing where we don't have to put down 20%. As long as the cash flow is $100, boom, that bill is down. And it's much easier to save for each time because now you're not paying for your internet bill. You're not paying for your water bill. So that cycle to save up for the next property comes around quicker and quicker and quicker because you're eliminating expenses. So your savings rate is higher. And then once you go through all your bills, then you're retired. And that's house fire. That's for me. And so now after I've done that, now I make up bills. I'm like, I want to go live in Hawaii for 3 months. Well, I don't buy a trip to Hawaii. I go buy a house that cash flows enough for me to spend 3 months in Hawaii. I don't go buy a Tesla. I got a Tesla Model X. I could give my cash over to the richest man in the world and he gives me a Model X. No, I get a lease. That's a 7-year lease, or not a lease, sorry, a 7-year car note, purchase it with a 7-year car note. And then I go buy a piece of real estate, my $100,000 that would pay for that car note. And then what happens is that house buys my Tesla for me. It burns up my Tesla bill. And then in 7 years, that Tesla's paid off. I didn't pay for it. My house paid for it. And now I've got the rental income from that house that I got to allocate somewhere else. What bill is that going to go pay for? Do I need another Tesla? No, let me go to Europe for 6 months now, And so that's how I look at real estate and overcome analysis paralysis is what's the biggest pain point? What's the expense I hate? Let me get a property to burn it up, the house fire approach. And then when I'm done, then, that's when when you're retired and you don't really have to do too much math. It's just addition and subtraction. It's really, really easy. Anyone can do it. And I really mean that. I'm a dumb dude. I just sort of trial and error and I've been at it, hacking away. Take my advice. This is a way to retire through real estate. And it's very easy.
I think anyone who's been listening to this episode would disagree very that you're a dumb dude. Lots of great nuggets in this one, Alan. And by the way, for anyone who's still listening to the show, all of the links to Alan's books will be in the description below. Go grab yourself a copy of House Fire. I'm going to read it. Sounds like a good read. So I'm excited to read it, man. Read it. And thank you so much for stopping by, Alan. This has been great, man. You've been a wealth of knowledge and hope to have you on again sometime.
Anytime, Danny. Thanks for having me. And hopefully you can turn this podcast into a gold mine.
Amen, brother.